right. This session is called Governance and Risk-Based Supervision, but that's not completely accurate because what we're going to be focusing on is more than just governance and risk-based supervision. It's principles-based regulation, which you've heard about today. Most of the sessions have been addressing that. Risk-based supervision, of course. But without effective corporate governance, principles-based regulation wouldn't work. And of course, a big part of that corporate governance is the role of senior management and the role of the board. And so we have panelists here, our fantastic panel here. Gian Guilfoy, CEO of Meridian. Anthony Piscatelli, Dr. Anthony Piscatelli. He's the chair of Your Neighborhood Credit Union. And from Caisse Alliance, the CEO of Caisse Alliance, Pierre Dorval. They will answer all our questions. And I thank you very much for being part of the panel. So what we want to do is tie in PBR, and I'll say PBR, Principles-Based Regulation, RBS, Risk-Based Supervision. Through the questions and through the kind of discussion that we have, it'd be good to tie in, PBR, RBS, corporate governance, and ultimately the benefits and the future of credit union, because that's why, as regulators and as the staff and the operators of credit unions and the board, we all want the same thing. We want credit unions and cases to be here forever, perpetually. And we all have a role to play, as we do as the regulator. And so in this very complex and changing environment, which I don't think it's going to abate anytime soon, and given that we have a very diverse credit union sector in, and apologies, Pierre, if I say credit union, I mean credit union and cases. It's a very diverse, not just geographically, but the businesses that they're in, the size, the complexity. And so a compliance kind of checklist approach, as you've heard throughout the day, doesn't really work. It's not effective. And so we've implemented this new principle-based regulatory regime. And what we want to know from panel is their experience with PBR and how that's gone and what they've done with enhancing their corporate governance practices to enable and use PBR to their advantage. Okay, so I'll start with the first question. That's for the entire panel, so any one of you, please no fighting. Whoever speaks up first, will get the answer first. Please tell us about your experience with PBR and this new implementation that FISRA has undergone, and what your credit union has done to enhance your corporate governance, and the impact that it has had on your senior management team and your board. So please, anybody.
I have the mic. Start with you.
Well, I can start with. I think it brought more discussion at the board level, and the board are starting to. I think we were into that mode since we've merged all our 12 caisses together as one. So we became a bigger credit union at the time, or Caisse Populaire, I should say, at the time, and we've started really working on the governance aspect of it. But what this brought is a more focused discussion around the board table, and we actually decided to split our board in different committees to look at different aspects of the business, and this brought a lot of good stuff around. And so this is one of the things. We're actually planning in the first quarter this year a work session with our management team to see how we can improve the information and the numbers or the information that we bring to the board. And this will start with the board asking themselves, well, based on that new way of doing it, which information do we feel we need to see more often? Which information do we feel we need to be able to get to make sure that we are in a good position to take decisions? So when they will bring that to us, we as a management team will ask ourselves, how can we improve the way we bring stuff to the board to make sure we answer that need for the board? So these are the work that is going on right now, and some part of the changes that we're going through.
So for me, this was brand new principles-based regulation. We hadn't dealt with this in the credit union sector or really any other board that I've been involved in. And as it came, one of my first kind of early realizations was that the checkbox system, as much as we grumbled about it, was really easy. you know, as a board member, you just knew, okay, we know exactly what we've got, check the box, we can go on to the next thing that we need to deal with. And as we start to delve into this deeper, and I'll touch on some of the advantages we see, I think this can be better for us as a system. It certainly is going to lead to better regulation, because we know the business and we know the levels of risk better if we're delving into that. So this sort of fits with the other trends around that increased requirement for board members. And for us, part of the realization here is that when we bring people onto the board and we onboard them, people that are involved in the board just need a different level of training now around the governance side. So people are bringing their individual skills, and that's important, but now we need to make sure that we're bringing that governance skill up to a level where they can contribute in a rapid way and really be able to understand the governance and our business in a way that can contribute to understanding the risks.
And I think for us, I think we were probably a little ahead of the pack with the subsidiary bank, OSFI regulated. We are already starting to move in the direction of principle-based regulation. So I think it has been a journey for our board and for our management team, really around things like the 3 lines of defense and making sure that we're appropriately, you know, monitoring the work that's happening, that it's being reported through various committees of the board, that they're comfortable with kind of where things are at. And so we've been sort of ahead of, I think a little bit ahead. So when things actually changed last year, I think we were comfortable that we could manage our way through the different approach.
All right, thank you. So I'd like to get a little bit more detail from each of you on some of the initiatives that you've worked on and enhancing your corporate governance. But some credit to Meridian and Brigitte Catelier, who was very recently awarded the Governance Professional of the Year award by the Governance Professionals of Canada. So this is just one of the pieces that's very indicative of the work that Meridian has done, not just very recently and not just because of what FISRA has done, but over the last couple of years, Meridian has put a lot of effort into enhancing its corporate governance and board effectiveness. So can you give us a little bit more insight into what initiated this, what made Meridian think we need to enhance our corporate governance and we need to modernize?
So I've been in the organization for a year, so I can't take any credit for the work. It started about 6 years ago, probably aligned to when we were thinking about starting a bank and looking at the work that we needed to do. But you know, it really set the stage for everything from looking at the criteria of our board of directors. I think there was a sense that, you know, we had grown so much, you know, we were a much more complex business, and we needed to refresh our approach and make sure that, number one, we had the right board members with the right skills and capabilities in order to, you know, provide the right oversight over an organization of our size. That was kind of job number one. And then I think job number two was then looking at board policies and committee makeup and making sure that we had, you know, all of the necessary tools in the board's toolbox to be able to have, you know, stronger oversight over risk and compliance. So those were sort of some of the big things that we did. We engaged with an external, you know, we did some internal work, and we engaged with an external partner to help us make sure that we were living to, you know, the governance practices that were best in class, you know, that our board members were getting training and education, you know, certification, things like ICD, all of that work. So I think what it's done is I think it's enabled the board to continue to be able to have a strategic overview over the organization, at the same time making sure that there is that integration between risk and strategy, because they really are the same thing, right? And so if we have the right compliance in place and we have the right independence, because we made sure we had a lot more independence for internal audit and for compliance and for the chief financial officer, for a chief risk officer. So making sure that they had enough independence so that they could be reporting directly to board committee chairs helped to sort of, you know, make sure that at the board level and the management level that we were actually doing what we wanted to do.
Right, thank you, Jan. And Anthony, I know your neighborhood has done a ton of work on this, and we commend you for the work that you've done, especially the board. Can you please give some insight on what you and your board have done to enhance your corporate governance, especially board effectiveness.
Yeah. So there's a number of initiatives at YNCU, and I won't get into all of them, but I want to touch on one. And it talks about the Director Competency Matrix that DICO around 2015 introduced, and FSR has sort of continued to use. And this is a matrix that, for those that aren't on the board, once a year we have to do this checkbox, and we sort of evaluate board members against a set of criteria. So the first time I did this in 2015, I'd been on the board a little while, but it was our first time doing it. I sat down and I did the checkbox, and I submitted it, and the board chair reviewed it, and he gives me a phone call and said, "Anthony, I need you to redo your matrix." I said, "What's wrong?" He said, you scored yourself way too low on all these items. I said, "I think I was reasonably honest." He said, no, this is going to our regulator. You need to give yourself a higher score. You're a board chair. You've got to look better here. So I redid it, and that made us realize, as chair of the governance, that this was not really a useful tool for us as an organization. With the move to principle-based regulation, Donna, our current board chair, and I sat down and said, okay, well, let's push the regulator a little bit and see, and I think they like it because they invited me to talk here, and see if we can make this a tool that's going to be more useful for us. So we went in and we've changed the categories. Yes, you need to meet a minimum competency level, but for us, when we were doing these evaluations, we want to be able to look a little bit about where are the gaps in our board, where are the strengths on our board, where are the areas where we need more training. So we've got a new tool that covers the same list that FSR provided, that does that with more detail. We've got that ability, one of the check boxes meets competency, is up to the level you need to be as a board member, but then we've gone a little farther to see where we've got really strong board members and where we've got some gaps. The other thing we've done is we've taken that tool and we've added to it. And we've added other areas that we feel are really important for our credit union. So we've got some around digital competencies. We've also got some around cooperative values and understanding. And we want to give some credit for that, which is something that maybe isn't as important for a regulatory perspective, but is important to us in terms of ensuring that we're living our values as a credit union.
So you can see why I like Anthony. He's very transparent. And this came up in the earlier sessions, that a big part of PBR and a success factor is being transparent, being collaborative, not just on one side, both sides, the regulator as well. And without that dialogue, we cannot possibly understand the business. And this is a conversation that I've had with everybody that's on panel here, and others that are in the audience. In the new PBR RBS environment, and when we're doing our assessments with the new risk-based supervisory framework, a big part of our assessments is actually assessing the effectiveness of the board and assessing corporate governance, which includes senior management as well. But how can you do that if you're just reading documents? You have to get to know the people. And to get to know the people like this, you have to talk to them, and hopefully in person. That's even better than being on just Zoom. So when a financial institution, when a board, when senior management are transparent with us, and we were just talking about this over lunch, this is actually conducive to the assessments. It actually doesn't necessarily mean, in fact in most cases, it won't mean that the institution is going to get an increased risk profile, even if you identify an issue, because what that signals to us is that you know what the problem is, you've been transparent with us, you have a plan, you're working on it. So there's no need for us to escalate or intervene. So anyway, long-winded way to say that you're very transparent, Anthony, and so is your neighborhood, and we really appreciate that, thank you. So Pierre, this one's for you. Caisse Alliance has undertaken, and excuse me, the people on this side, I keep turning to look at the panel, so I'm not trying to ignore you. But Caisse Alliance has spent a lot of resources, a lot of thinking, with a lot of intent to upgrade and overhaul your IT and banking systems. If you could just give a little bit of, maybe not too much, I know you're still working on that, but just a little bit of insight into that, and what got you to do this in-house, because you're doing this all in-house. This is game-changing for you. It's a very big initiative, and I know at the center of all this is your members. You did this for your members because it's what's best for your members. And what kind of corporate governance practices did you have to enhance to make sure that this initiative was going to be a success?
It is quite a journey, and we're still in it, like you said, and it's a big thing. But I think, first of all, one of the things that you said is doing it in-house and building a team in-house to be able to do it was one of the things that we've decided when we look at it as a risk and as a going forward or future for future success and everything, we said, well, if we build a team in-house, and we know, you all know that it's not easy to build a whole new team in this time, but we've been able to do it, was to be able to actually have experts in our credit union once the project would be live and done. So that was one of the biggest things, to be able to build that. And it's a big thing, but it's again, like you said, it's the member in the center of all of it. And it's when we've looked at it and said, well, I think we can do, the board actually said, well, we can still make a difference for our members in Northern Ontario, and this is the way to go. And this is where we've decided to go, and we've invested the resources and everything. But it is a big project, so you need to look at it at different aspects, make sure that you do know all the risks that are involved into that type of situation. You need to make sure that your board is aware. We always worked also with our community committees that we have. Those are the ones that actually represent our members. When we need the member feeling about a project, we go to them, because we have committees in every region based like that are formed from members that are actively participating in it. So it's always to make sure that we answer the members' need, and make sure also that all the stakeholders involved have the information that they need, making sure that they are aware that they follow the project step by step and know where we're going, and they need to know sometimes when we're going through, because it's not always a good day. I mean, every morning you get up and you might get the email saying, you know what, this can go wrong, and you need to look at it. But we all, as stakeholder, needs to know about these, and needs to know also the action that needs to be taken to resolve that. So that's the biggest thing, I think, and building it in-house has been so important also for the team building, and making sure that the employees get involved into it, because they're the most important part of that's being a success, is for them to accept the change, to know why it's done, to know where we want to go. And this is a clear success up till now, because they're all involved and they all want that to be a success, and that's what we're working on.
So do your members know, are they aware that you did this for that they were at the center of this decision, and this was really done for their benefit?
The members will know more as we go. They know that we're investing into and they know some part of why we are doing it. It's a little bit too far away from the change to be able to give some details, but it will be the 6 months before the project will go live. Everything will be explained to the members. The members always knew the objective of the board, to make sure to respond to their needs. So it's part of it, so it won't, it's not a surprise for them. We've been addressing that for the last 2 AGMs, where we've been talking about the investment that we were making and everything. So, but on a regular basis for the next few months, they will get information about it more and more.
Okay, thank you, Pierre. This next question is for you, Jehan, and it goes back to what I was saying about PBR can't be successful without good communication, bidirectional communication between the regulator and the regulated entity, in this case Meridian, and for the regulator also to have to be transparent. I mean, we expect that of the credit union, but there should also be an expectation that the regulator is also transparent. In fact, that's one of our 6 principles, to be transparent and collaborative. Has PBR changed your relationship with the regulator, with FSRA, and do you see this relationship changing because of PBR going forward?
I think it has changed. If I reflect back to sort of our first meeting when I arrived, I think it was a lot more prescriptive, and then as time went on, we certainly, we've done things like we're on a journey this year to set a new strategy, as you know, for our organization, and so part of that is when we meet with FSRA, the first thing I talk about with you and the team, or your team members, is where are we at in that process, what are we thinking about. So I think right from strategy through to looking at our controls and talking about it at a principles-based level, I think it does allow us to, as one of the speakers said this morning, to be on the same side, right? So if your job is to protect the public and customers and members' interests, we want the same thing. right? So if you can understand what we're trying to do with our strategy and the work that we're doing, then you can then understand where we're going to be looking most intently at the risks associated with that, where we think we need to spend more time, and we can be sharing that with you. So, you know, we have had a couple of things happen over the past number of months, and, you know, I felt entirely fine picking up the phone and phoning you or phoning Dan or the other way around in order for us to be able to work through it. And I think that's the transparency and the willingness to kind of work through things. I certainly see that in our relationship now.
Great, thank you, Cheyenne. Anthony, you touched on this, but not specifically on the Sound Business of Financial Practices rule. So last year, I think it was March of 2022, FSRA published the Sound Business of Financial Practices rule, and Tom, again, he didn't, Duca, he said Duca chair. You mentioned not exactly the Sound Business of Financial Practices rule, but you talked about the board having to, at some other point I've heard you talk about taking off the training wheels. You didn't say that today, but you've talked about stepping up the game for the board. So Anthony, the question's for you. With the Sound Business of Financial Practices rule that came into force almost a year ago, what changes have you made at the board level? What changes have you made at your neighborhood to be, I wouldn't call it compliant, because it's not about compliance, but it's to be aligned with the principles that are stated in the rule?
Yeah, so a big part of the work has happened at the audit committee, and that's where we really started these conversations as the new rule came. Audit committee chair, I reviewed them, our staff reviewed them, and as we started having these conversations, we realized that we already had an overwhelmed audit committee, and we likely were going to see more work being done there and more proactive works. So we're now in the process of redesigning our committee structure. So we're going to be looking at creating an audit and operational risk committee, a credit and market risk committee, and then the traditional governance committee, and then we do have an executive committee, but our executive committee is really performing more of the HR function than the traditional executive committee function. So we're looking at restructuring to make sure that we're in a position to really have these conversations at a level that's appropriate. The other piece that we spend a lot of time doing is, and this is integrating with some other governance goals. So we've really tried to take what FSRA's done. We've looked at it as giving us a little bit more flexibility, and we're trying to push the conversations at the board in a different, more kind of open direction. So we've instituted, and we're calling them committees of the whole. It's from Robert's Rules of Order. It's basically the idea that we're having more informal board meetings. And we're not doing this as every board meeting. We're doing it probably about 3 times a year. And in those meetings, we're tackling sort of generative topics that are emergent issues. And we're having really kind of frank conversations with the board and with senior management in those conversations. One of those things we stepped back and said, you know, as a credit union, we've had this traditional divide between the board and senior management. And at times, you know, that's likely needed. But if we were a traditional corporate board, there would be CLT members who are members of the board, and we'd be able to take advantage of their expertise on a more regular basis. So we're trying to do that as well in kind of an intentional way. And the hope here is that now we're having these forward-thinking conversations, that we're able to bring in where we want to go with strategy, and then also have those risk conversations early in the process. And we're doing more sense making, right? So we're trying to figure out what are sort of some of the right questions that we need to ask about our organization, and some of those will be risk-based questions. And we do that early in the process. That hopefully gives the senior leadership team enough time to address them and move forward.
Thank you, Anthony. Pierre, the next one's for you. Credit unions, in cases, are now required to have a market conduct framework. Some already did before FSRA even required it, but now it's a requirement for all credit unions in cases. Your case and other credit unions already meet the cooperative principles and values. How have you used those cooperative principles and values to leverage and to meet an effective market conduct framework?
Well, actually, like you said, it was already something that was in our DNA from the start. So it wasn't a big challenge to put it in. I think what it brought us to do is actually go to details with employees, with the training of like remembering this or remembering that, what is important with the members, what is not, and like it was part of our day-to-day operation to be able to be there for the members and respond to the members no matter where they are the center of every action that we do. So the market conduct didn't bring that much change for us, more than bringing us, I think, to come back to the table with the employees and making sure that we do speak about all those details and everything. So it was a very good thing, and it wasn't a big thing for us to put in because it was already part of our day-to-day operation.
And Jan, what has Meridian done regarding the market conduct framework?
So I think very similar to Pierre, we obviously cooperative roots, always caring about ethical behavior and making sure that we've got the practices in place for our employees, and we have processes in place for our members who have issues. So I think all of that was in play. It was certainly enhanced, and we've gone through looking at all of our policies and our procedures and right up to the board, and we've instituted a new one specifically for the board, and we've addressed things that maybe weren't as clear in our policies so that we could be even better at it. So I think it allowed us to take some time and reflect and make sure that the things that we were doing were still the things that were the right things to do. I think ultimately they were, but we got some enhancement out of it.
All right, thank you. I mentioned a little bit earlier about the risk-based supervisory framework that we implemented April of last year. And this is our new methodology under the PBR-RBS umbrella. It's our new methodology on how to assess the risk profiles of credit unions. It is comprehensive. For example, we look at the subsidiaries of the credit union or the case as well, not just the credit union or case. And it is also integrated. And by integrated, we mean that it looks from the perspective of solvency and prudential, but it also has the perspective of market conduct as well. And so a part of this assessment that we use through RBSF is assessing the resilience of credit unions. As we've seen, resilience is not always about risk management. Once a stress hits, like we saw in the beginning of 2020, it's not just a matter of risk management. It's not just a risk management mindset anymore. It's about being resilient. And credit unions have proven to be very resilient. And so my question to all of you is, what can we do to ensure that credit unions are resilient going forward? How can we improve resilience? And what can FSRA do to enable this, to improve this? What part can we play?
I'll jump in first on that one. One of the strengths that I really see of the credit union system is that there's so many different credit unions in existence. And it's something that I lament to a degree that we're losing that as we go through mergers and consolidation, but I recognize the reality that we probably need to have these mergers and consolidation to get it to a size where we can continue to compete. So to me, my hope is that the credit union system will continue to be innovative, and we'll continue to have different credit unions trying different things. And to me, it's not, on the short-term time horizon, it's probably better if we don't take a risk that fails. On the long-term horizon, it's probably better for the system as a whole if some credit unions are taking some risks and pushing those boundaries. Those credit unions that are taking the risks do need some extra attention as part of it, and likely the regulator at some point may need to get involved. But I think part of the strength of the system is that we're trying different things. It creates, of course, a risk for us if one credit union fails. It hurts the whole system. But I think the reason that you fail matters too. So PACE hurt the whole system because we looked really bad as a system because of one credit union screwing up. If a credit union screws up because they're trying to do something innovative that helps the consumer, that's capitalism. That's sort of the reality of it. And then I think we're in a situation where the regulator needs to step in and do some corrective actions. It's probably okay and probably more forgiving within the wider sector. So I'm looking for the regulator with the PBR system to make sure that we have the flexibility to still be innovative as a system, and that innovation is likely going to come from individual credit unions trying new things that if they work, they'll scale up to the whole system. Hopefully if they don't work, it'll be small enough damage that it won't actually harm that credit union. If there are a few credit union failures because of that innovation, I think that's probably okay though. And I like that the regulator is in a situation where they can help and make sure that the consumers don't lose in those circumstances.
You know, I think, I was just thinking about the question, and I think at the end of the day, I think it is, you're gonna help us be more resilient by having a balanced perspective. You know, if the last 3 years are indicative of the next 3 years, and I think, you know, I think they are. I think that 10 years preceding that, you know, I think that those days are over and we're now in a new regime. So I think it is about balance because, you know, I look at the roots of the credit union system being there for people who could not get access to money from the banks. Like that's the whole purpose of the credit union. That's how it was, the credit union system was born. And so that means being creative and innovative and thinking through things like that we're starting to do, thinking about our biases in our credit policies and how we apply, you know, decisions to everybody from everywhere. And so that could be in direct conflict with sort of, you know, at the highest level, you know, keeping us in a swim lane that keeps us safe and sound, right? Because to Anthony's point, it might mean we want to do things that are different. Because we know, you know, people who aren't given the proper access to regulated financial services, as we heard this morning, are going to other places and they're being treated horribly and they're paying crazy rates for the money that they need. So I think it's always remembering that we are not a sector of publicly traded financial institutions. We are a cooperatively owned, member-based, and so how do we make sure we have that?
Yeah, please.
Well, we heard this morning a lot about communication, courage, the principle basis approach, the risk basis approach, and all of this needs to work together. And I think it's, I'll answer it with humor. I had a few comments this morning about my suit. And so when I looked around the room, I realized that most of the men were wearing black or blue, and I was wearing a different color. So when you look at what was said this morning, the rule is the same. We need to be dressed to come here. So this doesn't change. So in my mind, probably I asked myself, is it riskier to wear purple than wear blue or black? And I probably said, you know what? No, it's not. But us, you as a regulator and me as a credit union, we need to be on the same page on that. You might not like purple, and I might enjoy wearing purple, so we need to be on the same page on that, and this is part of the challenge too, to be able to work through it. And probably wearing a bathing suit to come would have been more riskier than the purple.
But it would have been okay.
And I would probably need attention at the time, so that's my way of looking at it very simply, but it's all based on every one aspect of that needs to work, and every stakeholder in there needs to understand it right and work the right way to be able to go through. And I think, like Jeanne said, it is the way to go to make sure that we can provide the good services to our members like we've been doing for so many years.
Good point. So what I took from that is I need a purple suit because you look great in that purple suit. So I'm glad you wore it. Thank you, Pierre. Okay, so we have 11 minutes approximately, but when I look at my clock, we have maybe 12 minutes. So there's a clock over here too that's ticking down like a bomb is about to go off, but I assure you it's not. So there's a question that I see that's come online, but what I'm going to do is take it to the group here. And you're waving the mic. All right. So we have a mic, please. Oh, we have one taker over here.
I don't think I'll need that. So maybe I do for the people. I'd like to follow up with Pierre's comment just now. It's quite interesting because you're in a new regime, a regulation where you have a change in possible expectations. So, and some of these principles aren't perfectly worded such that you know where to go and how to execute to satisfy the regulator. Having worked at a national regulator who isn't the best at that at times, what do you do if you have a principle in a guideline or a regulation with FSRA? Like, are you courageous enough to challenge and ask for the expectation, a minimum expectation that they expect to see in order to say that I've passed that test or I've passed that requirement? What are your behaviors, I would hope, have changed since the regulation process has changed too. So I'd be interested in that comment as well. Like, is this something where you have more dialogue with the regulator to understand what those minimal amount of words in the principle mean to you? Any of you?
So we're going through a assessment right now. What do we call it? Review? Assessment. We're going through an assessment right now. So I'll be able to better answer your question after that. But I would say from an ad hoc perspective, as requests have come to us, and if we haven't understood why, what was the principle that was applied to, then shame on us. So we park the call and we have a conversation. And quite honestly, some of the stuff is still in process, even for FSRA, right? So it's not just, it's in process, and so that means it could go one way or it could go the other. But I think next year I can answer that question, hopefully.
And we're in the same process right now, so we're going through an exam.
Assessment.
An assessment. It's on the letters, that's why. But it's no, but we're going through, and I see a difference in the discussion we're having, and I see a difference also in the expectation that are put on us also to be able to do that. So I expect that to go on the right way, but I think we all can become better at what we do, at being able to also get more prepared to be able to explain our principles or on what we are basing our risk analysis and everything, to make sure that everybody's on board, that all the stakeholders are on board. So I think it is a work in progress that we're going through, but I see good things already going.
Anthony, did you want to?
So we haven't gone through our assessment since the process has changed. I will say though, as a board member and board chair, I've had more interaction with the regulator since this shift has taken place, and I think that's certainly worthwhile. I'm at a point now where I feel comfortable picking up the phone and making a call if I felt it was necessary, which is certainly not something I would have felt comfortable doing 5 years ago.
All right, thank you. So there's a question that's come online. I have a horrible reading vision, so I'm going to try to do an okay job of this. It says, with the reliance of governance within the credit union case sector, will there be further oversight or prescriptiveness over the bylaws under which they operate? For example, length of time by which the individual can be on the board. I think that's a question for me.
I think it's a question for you.
Is it for me? All right. Well, this is not supposed to be about me, but okay, I can answer this one. So no, we're not going to be prescriptive, but you've heard this throughout the day as well, that principles-based doesn't mean that we step away, we state the principles, we put them up on a website somewhere, and then we step away. In a principles-based environment, you need also to look at risk, and if there is an institution or an entity that has elevated risk profile, we do intervene. We do stay principles-based initially, but if that institution, in this case it could be a board or senior management, are not taking the remedial actions that are required, and by that I don't mean we outline step by step what they need to do. That's not principles-based. We outline the outcome that we're looking for, and how you get there is up to you. That's the principle, right? You know the principle, you know the outcome. How you get to that point is up to you. But if that's not happening, and it's not happening in a timely way, then we will become more prescriptive. So for example, with, let's say, a board, and someone's been on the board for 10 years, that may be okay. That may not be the best practice in some sectors, and I'm not telling you that that is best practice, but we're not going to come up with guidance, at least not yet. We don't intend on doing it unless there is prevalent kind of behavior like this, where we see board members being on the board for 10, 20 years and they're doing a non-effective job of being board members. Unless we see something like that, then we might change our position, but currently that is not a prevalent issue. So it's possible for a board member to be on the board for an extended period of time and still be doing an effective job. But good practice states that there should be some limits on terms, and we would encourage that, but we wouldn't require that. So we would expect that if you have a modern, effective, and enhanced corporate governance practices that you put in place, that you would on your own make a decision as a board to put that in place.
Can I jump
Of
in
course,
on
please.
that one? So to me, as I see that specific issue, I try and look at what is the principle. So instead of the past, we would go to, okay, what's the term limit that is reasonable, and the conversation would just be about term limit. So now when I look at that, I'm trying to roll it back to say, you know, what's the reason behind why we might be looking at term limits? And to me, it's about independence of directors. And that's what the principle kind of underlying this is, that we want directors who are independent. We also want directors that are knowledgeable. And when we look at the corporate sector, they've got a similar situation where they will have senior leaders that are clearly not independent that are serving on the board. So in Britain, what they have as a rule is after 10 years on a board, you're no longer considered an independent director. That doesn't mean you can't serve on the board anymore. So to me, if I'm looking at something like this, the conversation I'd likely be pushing YNCU to have is, at what point do you likely lose your independence as a board member? And then when you've lost that independence, are you still able to contribute? I would suggest you probably are, be a board conversation, but maybe there's certain things that you shouldn't be doing anymore. Maybe you shouldn't be on the audit committee at that point anymore because you're not independent enough. The other piece I would look at there and say, okay, it's probably okay to have some directors that are not independent, but as soon as we get to the point where, you know, all 9 of us are not independent, well, are we no longer bringing in innovative ideas? So to me, that's the principle-based conversation that I'd be expecting to have at the board, which is certainly different than the conversation we had when we put in term limits. It was, you know, what's the industry standard in terms of term limits, and no conversation about why are we doing this? What's the principle behind this? How can we make sure? It was a compliance conversation that said we need a term limit. What's a reasonable term limit?
I think that's a very, very great point. Like, I think the thing that's good about the PBR is that it does put the decision making into the hands of the board based on, you know, what makes good governance of a financial institution that's also a cooperative. And I think, you know, even our structures of committees and stuff are very different, but we still have good governance over our entities.
All right, Jan and Anthony, thank you very much. Any other questions from, we have a gentleman on the left-hand side here. If you could please introduce yourself as well.
Good afternoon. My name is Larry Swiniarski. I'm a relationship manager with Israel. It's a question for Anthony. You piqued my interest. You're talking about the idea of innovation for the credit union sector on an individual basis, entity by entity. It sounds like you're talking about disruptive innovation. But when you talk about innovation that could actually threaten the existence of a credit union, that sounds like creative destruction. So could you give an example of what you meant exactly by innovation that actually might threaten the existence of a credit union? I understand the idea of, you know, doing your best and being forgiven for a well-meaning mistake, but that level of risk goes beyond most risk statements I've seen by the boards.
Yeah. So I think I'm seeing kind of a long-term situation where I'm not sure. I'm not sure in the long term how competitive we're going to be as a system. And I guess maybe I've been a little too extreme in that. And thank you for letting me roll that back a little, because I don't think I'm thinking innovation that would necessarily threaten a credit union. But if some small credit unions are kind of jumping into commercial lending pretty aggressively, it may put them in a situation where they're threatening their kind of capital levels. And maybe, so I think some credit unions may want to make a market position where we go pretty aggressive with offering really good mortgage rates. And you know, that may lead to the idea being we're going to grow. So we're going to offer really good mortgage rates, and we're going to grow, and then we're going to bring people in to backfill afterwards. And I think that's probably a riskier strategy, and you're right. Hopefully it doesn't rise to the level where it's actually risking the viability of the credit union. But I'd be okay if some credit unions are kind of pushing those boundaries, and then the regulator, I know, is giving a little more attention to those credit unions that are doing that. And it may be that you're pushing them into a merger a little bit faster and go, okay, good strategy, idea, you know, somebody should have probably done this, but it didn't work, so now you've got to get an exit strategy. We're going to be disrupted around the open banking piece, and you know, maybe it's not going to come as fast as we sort of expect this to come. But as things like that come down the pipeline, I do worry about the long-term viability of the sector as a whole. And you know, some of the conferences we've been to, there's talk of there's maybe only a few large credit unions that actually survive in the long long term. So I think we need to be kind of having a few credit unions pushing the boundaries. The other piece that I think we need to see, and I'm really glad to see this, we've got a couple of new credit unions kind of jumping into the market now. And it'll be interesting to see if they can succeed. If you expect a credit union to come in with I'm glad FSRA has sort of tweaked the guidance here that allows them to ramp up to get to the capital levels. But you can't expect somebody now to jump in and and to meet the capital requirements at a strict level on year one. So we've got new entry guidelines. And some of those new credit unions may fail. And they may fail because it's going to be hard to get to those levels in time, or they may fail because startups often fail. I don't think they will. I think they've got good plans from what I've seen. But it is possible in the future that we may end up with some new startup credit unions. And maybe we'll have some credit unions do some of the innovative stuff like the peer-to-peer lending. Maybe there's a model around that can exist in the future. But something like that may not be successful. Yeah, so thank you. I was, even after I finished talking, I was like, thinking, I was like, I was probably a little more extreme than I actually meant with that, so I appreciate giving me the chance to walk that back a little bit.
So we have 1 minute left, and the last question I'm going to ask is ultimately everything that we do, whether you're a credit union or a regulator, we're doing it for the members. So along the lines of consumer protection, which is the theme of FSRA Exchange, what will, and I'm going to ask this of Pierre and Jan, what is going to differentiate credit unions and cases from other FIs going forward? Pierre, please.
Well, I think it's our connection to our members. I think the biggest thing that was said this morning is we're not dealing with customers, we're dealing with members. And as long as this stays into our values and stays into our way of looking at our business, this is the biggest distinction. Like, my board is always making sure that we have a place where we can go back to members all the time, and this is our committees, our community committees that we keep nurturing and making sure that they're there to respond. And this is the biggest thing. I mean, it's the reason why we exist, like Jan said, is to be there for the members that need us and that are not well served by the rest. And it turns out now to be that we're partners in their life and they need us to be like that. And I don't think it's a big change from what we are now. I think just to keep on doing what we're doing and having a regulatory environment where we can continue to do it in a well-managed way. I think that will be what we need to differentiate, to be different.
And I think similarly to Pierre, we were born as ESG organizations a long, long time ago. And so I think leaning into that into our future so that we make sure that we are taking care of people in communities. So we heard a little bit this morning about the digital divide. I think we have more interest in solving that for seniors and solving that for new Canadians because, we are also embedded in community. So I think as long as we are looking at our role within the communities we serve in a holistic and systems way, I think we'll be fine. I think the minute we start thinking of ourselves as a bank, I think is the minute that we're on the slow decline to nowhere, because there's no way we could compete with now RBC, HSBC combo. I think it is that understanding our role in community and lifting up everybody through providing economic opportunity, helping communities thrive and prosper, being there to integrate with systems and processes that serve everybody. I think that's where we'll win.
All right, thank you very much. So that's it, we've reached the end. I want to thank you very much for those people who've attended in person and those people who've attended online as well. Thank you very much. This has been a fantastic event. We really look forward to seeing you next year. I want to thank the public affairs team of FSRA as well for putting this event on. They did a fantastic job. And of course, I want to thank Jan, Anthony, and Pierre. You've been a fantastic panel. Thank you very much.